Hey Mario, how you making out?
Hey, doing great, Bob. How are you?
Very well, very well. Despite our volatility here, it's obviously been another roller coaster quarter. We thought we were getting a little relief in July and gave it all back in August and September. But you're going to be here to just give us some updates on what's going on, and of course, the usual rhetoric. No prognostications. We're just here to report on what transpired and give you a little color over the past the third quarter of 2022. So I won't take too much time here. I appreciate your diligence and effort in putting this together and giving us an opportunity to hear your insights and what's going on here. So thank you, and I'll turn it over to you, Mario.
All right. Thanks, Bob. Happy to be here once again. Let's jump right into it. As Bob mentioned, it's been a rocky year so far. Here we are in the middle of October. Lots happened since, the end of the third quarter. But as Bob said, we're here to make sense of what's happened, digest it, take a look at that roller coaster. Not, don't want to sugarcoat it. But for those of you that have tuned into these presentations before, we don't try to get too optimistic, and we're also not trying to be too doom and gloom. So with that being said, let's go to our favorite slide where we actually do give a look at some reasons for our positivity and then possibly some reasons for hesitation as we look in the financial markets. On the left side of the page, bullet points 1 and 3 sort of indicate the silver lining of what we see in equity and fixed income markets after the decline that we've suffered through this year. And what I mean by that is, the fundamentals of the underlying stocks and bonds that we invest in our portfolio are not that unchanged from where they were at the beginning of the year. So the outlook going forward for the underlying assets are still pretty good, pretty okay. Let's leave it at that.
Yeah.
But prices have come down a lot. So that means on a go forward basis, the yields on fixed income and the expected returns from equities are in a better place now than they were at the end of last year. The second bullet point about inflation, 8.2 is super high, but at least it's come down from the 9% highs that we saw back in June. And on the right side of the page, the reasons for concern almost exclusively on the geopolitical front. The Ukraine situation is dragging on, and who knows for how long. That last bullet point there really indicates Russia is one of the biggest wild cards that we're facing today. And then the second bullet point, still questions about whether or not the Fed truly has a handle on inflation or whether they're going to have to take even more drastic measures that could have a negative impact on the economy. So let's get into some of those details. And let's start, where probably everybody expected us to, that being the inflation story.
Sounds good. Thank you.
Yep. So if you've seen these before, you're familiar with this slide. The title of the page is a reminder that the Fed does have a mandate to maintain about a 2% inflation rate. And if you look at the graph there, you see that for the bulk of the last 40 years, we have seen inflation within range of that 2% target, probably more likely between 2 and 3%, which the Fed and our economy can live with. But if you look at the far right side of the page, you see just how much inflation has spiked so far this year. And if you look at the inset, you see those numbers coming in at 8.5 in July, 8.2 in August. September number came in at 8.2 again. Again, a little bit elevated from what we'd prefer to see, but coming down from those highs back in June. And I want to make sure, Bob, I know you and your audience know how important inflation is from a spending perspective, but we don't want to diminish the importance from inflation from a lot of other factors. How it impacts government policy, how it impacts corporate profits, housing affordability, not to mention labor costs and other economic factors. So to say inflation is important is probably an understatement.
Yeah. Yeah. No, it's a huge factor.
Yeah. So, and let's look at this cartoon. I know we don't often use cartoons, but this we thought was a great analogy for why the Fed's job is sort of like driving by looking in the rearview mirror. We already talked about inflation being one of the Fed's mandates, and that's represented in the rearview mirror by the CPI number. Its other mandate is to keep unemployment low. Now, the problem is, and why this analogy works, is that we don't really know where we are in these numbers until after the fact. September's inflation number just came out on Friday, for instance. So the Fed's trying to make policy decisions in real time with information that's already stale. And as you could see in the cartoon, you could see that there are so many other factors and hazards in the road ahead. And the Fed needs to be very careful about, steering the car or, hitting the brakes or the accelerator without taking all these other hazards into consideration.
Yeah.
And if we want to continue that driving analogy, what this slide really does is take a look at, whether or not the current critiques of the Fed are warranted. And the critiques meaning, did the Fed take too long to respond, or have they not raised rates fast enough? And now they have to overcorrect, kind of like overcorrecting on an icy road. So that remains to be a question. But what you're seeing on the chart is at the far right, if the current projections of where the Fed is heading are correct, then we would be in the midst of the fastest rise in the Fed funds rate since the high inflation years of the early 80s. And that's pretty profound and certainly uncharted territory in the modern economic era. So that's sort of why people are uneasy and unsure about where we're going from here. The title of this page, Keeping at It, is something that Chairman Jerome Powell recently alluded to in reference to Paul Volcker's book. Paul Volcker was the Fed chairman that oversaw the rate increases in the early 80s and really ushered in the new era of Fed policy, where that was specifically what they were going to do, is adjust the rates to keep inflation and unemployment in line. And he famously said, we're going to keep at it, meaning raising rates until inflation is under control, regardless of what other implications that might have in the economy. So that signal by Fed Chairman Powell is a clear one that inflation is, right there in their sights and probably going to garner the majority of their attention, almost regardless of anything else.
Yeah, listen, well, I'm trying not to interrupt here too much because I know there's a lot of content, but one thing I just want to say is this. I mean, I'm not terribly surprised, and a lot of people shouldn't be necessarily. I mean, if we go back from the Great Recession, 08, 09, and all the quantitative easing that took place, and then all the recent stimulus, I mean, back then there was a ton of fear that we were going to run into a major inflationary environment with the amount of money that was being thrown into the market to improve liquidity and boost the economy. And this time the same transpired. It was just this time was a little excessive. And also with COVID and everything else taking place, there's definitely a lot of variables that are playing on this. And but I'm glad that we have the government has some tools to attempt to get this under control. I just need to keep it at that. But I'm not terribly surprised this is taking place. And thankfully, one last thing is that having a plan in place to know where we're going to get cash flow for our clients, and a financial plan that puts in some expectations of poor market performance, no matter how it shows up. Depending upon whatever the factors are. It's baked into people's plans, so it's not a total surprise.
Absolutely, great point. Yeah, as you look forward in a financial plan, you predict. I don't want to use that word, Bob. Don't
it's just it's a factor that it's going to happen, so it needs to be added as a risk for people's financial plans. So we know it's going to happen, so we can't elude it. It's just a matter, we don't know what it's going to look like when it shows up.
Exactly.
So, yeah.
Yep. Okay. So with that being said, part of the concern that some have over Feds needing to overcorrect is the other headline term that we're hearing a lot about besides inflation, and that is the R word, recession. That being said, going back to everything we've talked about already, we're not looking at this to make any kind of predictions. We're not looking at it to determine where we need to be positioned from an investment perspective. We really just want to have an understanding of what this all means. So regardless of how often you hear the term recession, don't start worrying about your investments just yet. Certainly don't try to make any adjustments around it. And this slide is a really great example of why we shouldn't do that. What you're looking at here in the shaded region is the yellow bar represents the decline and then the rebound of the stock market during the COVID recession of 2020. So that we know now that that shaded area was a recession, but follow along to the right and you'll see that first dot in June of 2020 was the first time we knew definitively that we were even in a recession that previous February. Yeah. So if you're looking for the announcements of whether we're in a recession or not to make any predictions or assumptions about the stock market, you're going to be way behind the eight ball because the market already declined and rebounded by the time we even knew we had a problem. And then when we actually found out we were out of a recession in April of 2020, doesn't even make the page. It happened in 2021, almost a whole year later. So it's good to know what's going on in the economy, but we have to remember that old saying that the economy is not the stock market. Don't try to use one to make any presumptions about the other. Yeah. So this is something that you often hear about, but it isn't always well explained, and that is consumer sentiment. Consumer sentiment is extremely important, not just as a gauge of how things are going, but where we might go next. And the reason is that sentiment drives consumer and investor behavior and activity, right? If you feel good about things, you're going to be more willing to spend money and invest and things like that. So it is an important thing to look at. This graph is extremely busy. So rather than taking the rest of our 30 minutes or so to describe this graph, I'm just going to focus your attention on the inset. And what this whole thing is trying to tell you is that the stock market has performed extremely well on a going forward basis when sentiment is at its worst. I'm going to repeat that. The market performs better on a going forward basis when sentiment is at its worst. That's seemingly counterintuitive, but what it really tells us and what the main takeaway is from this page is that the market is forward looking, and the market and market prices, stock market in particular, has already baked in that pessimism into current prices. So using all these famous investment axioms, this is another situation where you want to be greedy when others are fearful. Warren Buffett's often attributed to that phrase. I assume he came up with it first, but it's been used a lot since then, and it makes a lot of sense. Anything to add on that one, Bob?
Yeah, the thing I would say is that we show an emotional roller coaster talking about, what people would be feeling, exactly these sentiments. And this is a more granular view of what we show to our clients. And the objective is to design a portfolio that is going to allow them to tolerate these types of swings based on their individual and personal circumstances. And so that way, when the market is at a low point for them, or for their investments, they're not capitulating and jumping out and saying, I have to sell everything. That will get to the other side and allow the recovery to happen after we've had a number of people that'll say, well, can't we just go to the sidelines for now, and when things level off, we'll get back in. And the problem is, no one wants to get back in until they feel better. And like you just said, sentiment needs to improve. And at that point, the market has already recovered. So this comes back to the point of, stocks are potentially, the stocks are priced appropriately, but they're less expensive than they were 3 months ago, 4 months ago. Let's say since the beginning of this year, the beginning of January. So considering that they're less expensive, it's not a time to jump out. So that's
correct. Yeah.
But yeah, this is
totally agree with that.
This is just showing a more granular view of the the emotional chart that we show people on the roller coaster that they live on when investing.
So on the left side of the page, you see what's known as the U.S. Treasury yield curve. Effectively, these are the current yields, or the dotted blue line represents the current yield curve, and that is the yield on a Treasury bond of varying maturities, from short term at the left side of the page to longer term at the right side of the page. So if you compare the line representing September of 22 versus the solid blue line of 12 months ago, that tells you just how much bond yields have increased. The Federal Reserve's movements control the left side of the page. And we know that they've said we're going to raise rates to 4.25%, 4.5%. So short-term Treasury bonds have followed suit. Now, the reason why longer-term yields have not increased proportionally is because the market is currently anticipating that the Fed's movements will, in fact, cool off the economy. And before we reach that 5, 10, or 15-year period of time, the Fed will likely have to start easing back and lowering rates to a certain degree. So again, the market is in belief that the Fed will get inflation in check. That helps us when we get asked, hey, what do you think? Is this going to work? Is the Fed going to rein in inflation? We don't know. We don't believe like that we know more than the market. We believe in the wisdom of crowds, and collectively there's a lot of capital at stake. And the current capital that is being staked is implying that they believe the Fed will get inflation under control. I don't want to belabor this slide too much because we're going to talk about some of these other points on other slides. So this page bears out the impact on bond returns when you see a rise in yields. You may remember from past conversations that page, unfortunately, shows us that there's been nowhere to hide in the bond market. Both the quarter, the year to date, the last 12 months, every category that we monitor in fixed income markets is negative. And the one I'll call your attention to that comes as a surprise in some instances, and that is the inflation protected category, the gray bar that's at the far right of each of these time periods. And while the inflation component, right, inflation protected bonds are supposed to go up when we see inflation. That component of these bonds did in fact go up, but they are still subject to changes in overall yields in the marketplace. And over the periods in question, that change in yields has been greater than the positive impact of the inflation adjustment.
I'm just going to give people a little other content here as well, and we do have a lot of savers and people with a fair amount of fixed income in their portfolio. You cut out there for a second, Mara, so you may have covered a little bit of this, but higher rates are good for savers. For years it's been troubling when you're getting 2.5% return on a moderate fixed income portfolio, and now if the rates can increase here a little bit, assuming inflation gets tapered, that's a much better place for people to be in. And this shock to the system on the bond side is that, it's exactly that. Hopefully it's more of a short-term type of dynamic. And most of our clients, we're looking at about 5 to 7 years of maturity on their bonds, like when they would come due. And the reason that's important is as the bonds come due, they come back to full face value. So it's just what we're doing, what's being adjusted here is the drop in rates, or the increase in rates drops the principal value of the existing bond because people can purchase a bond with a higher yield right now today. And so people are not going to pay the same price. And we'll get into that whole conversation. But I just want to give people peace of mind and ease that the bond still has value. And as it comes due, it reverts back to its normal pricing. And this is potentially advantageous for the long run for savers.
That's a great point about the bond price coming back to par value if held to maturity. And we're actually gonna put some numbers behind your comment about why this is good, and why I alluded to it in the original bullet points, that on a going forward basis, we'd rather be where we are now than we were 12 months ago.
Awesome.
So just to really put in perspective about, how challenging and unique of a period this year has been for the bond market, this graph shows you the previous worst year for bonds before this year. And I was even surprised to see that the worst full year for bonds was 1994, but the return was only negative 2.5%. I would have thought we definitely have had a worse year for bonds than that. Well, we have now, unless something changes miraculously for the rest of the year. You see that bottom line that's incomplete because we're only through October. You see so far this year, our bond market's down 13.75%. That is a drastic difference than in the past. But if we start rationalizing it and thinking about it, it shouldn't really come as a surprise. We know that we've had yields come down over the last 40 years, and now they've gone up really quickly. So just alluding back to what Bob just talked about, the fact that yields came back up, we know we should expect a decrease in prices. We just didn't expect it to happen that fast. Now, silver lining, look at that top yellow line, 30% positive return for 1982. That's a year after the very challenging bond market years of 1980 and 81. So if nothing else, it gives, lets us know that there is hope for a recovery. And this next slide is going to tell us that there's more than just hope. As Bob mentioned, and we've kind of hinted at a number of times already, the blue diamonds represent the current yield of various bond categories represented by each of these columns. And the numbers at the top represent those yields. The range, the gray bar itself, shows you the range of what those yields have been over the last 10 years. So you can see that whether we're talking about US Treasury bonds, municipal bonds especially, corporate bonds, mortgage-backed, pretty much any bond category you can imagine, the current yield is as high as it's been in the last 10 years or so. So for savers, I'd rather take let's even call it a 10% hit at the beginning of the year and get 6.8% or 6% per year going forward than not take the hit and get those paltry 1 to 3% per year yields for the rest of my life. And I know that might be skewing or spinning it a little bit, but in reality, the math works out better for having taken the hit and getting a higher yield going forward.
That's right.
I mentioned munis. We don't often focus our attention too much on municipal bonds, but especially for taxable accounts and investors in higher tax brackets, municipal bonds look extremely attractive right now, at least relative to treasuries. We often think of them as having very similar credit exposure, so full faith and credit in the taxing power of municipalities, states, what have you. Fairly equivalent to that of treasury bonds. That's a broad generalization, but the moral of the story is if you are in an elevated tax bracket, the yields on municipal bonds now are extremely attractive. What you're looking at here is essentially a tax equivalent or a tax adjusted municipal yield curve versus treasuries. So, and this uses a tax rate of 37% and all the goodies that go along with it, like the Medicare tax rate. So if you're somewhere near that, then I'm sure Bob and his team are already talking to you about having some munis in your portfolio.
Correct.
Going back to equities, the US stock market, you could see that third quarter was another pretty dismal story after a dismal first half of the year. The only category, if you look at the third quarter bank of bars there, you could see there was only one category of US stocks that was positive, and that was the small cap growth segment. But, it's a rounding error, right? 0.2% positive return versus a range of -2 to -5.5 for other categories. For the year to date, the only size and style category that isn't in bear market territory, which is usually defined as a drop of about 20% or more, was large cap value, the yellow bars. And we don't want to get into too much of that, but you may know or remember that we do have a preference for value oriented investments. They tend to help us in environments like this when growth is out of favor, when the markets pull back quite substantially. It's little consolation to have a better return in down markets, but when you take it all together, it does tend to help us in the long run to have this type of approach. Now, to parse out the US markets a little bit differently, instead of size and style, this chart breaks it out by sector. No surprise, we've had a period of time where oil prices are up probably about 15% as of the time of this chart. Energy stocks up pretty substantially for the year to date and the 1 year period. Energy high oil prices are generally good for oil companies' profits, generally pretty bad for every other sector. So on top of everything else that's going on, energy, transportation, heating, all that stuff, energy is a cost for the majority of other sectors. So certainly a contributor to the negative returns, a positive for the energy stocks themselves.
Yeah.
The story for non-US stocks, unfortunately, has been similar to those in the US, and it's not a happy one. That being said, the returns for year to date and 12 months ranged from minus 25 to minus 32%. These are the two center and right columns here. But the silver lining here is that, or I guess more like something to understand, is that a good portion of that was due to the appreciation in the dollar. For example, we use the MSCI EFA as the index for international equity large cap, the blue bars here. So that index was down 27% year to date, but the underlying stocks were only down 14%.
Yeah.
Because the US dollar appreciated over that period, that added another 13% of underperformance. And I know there's some technical aspects to that, and we've defined that and described it on previous calls, and happy to take calls that require more explanation. But effectively, we recognize that when we invest in non-dollar assets and the dollar appreciates, we have to expect pressure on our investments. The reason for the dollar's increase, we'll talk about on the next slide. Since the dollar has been a major story, this slide is kind of a mainstay in our slide deck. And what you're seeing is the Wall Street Journal's dollar index, which represents the value of the US dollar versus a basket of 16 other foreign currencies. The top graph shows how the dollar has strengthened over the past decade, so the right half of the page. And that has been essentially since the period of the Great Recession, but had fallen by about the same amount in the decade previous, the lost decade, the decade following the dot-com bubble bursting. Yeah. The bottom graph shows the dollar's appreciation just in the third quarter of this year. And some of the major factors to that dollar strength is, number one, the slow global economy, right? The US is chugging along with 3.5% unemployment. Lots of other parts of the world not really, doing so well coming out of COVID. So those dollars tend to, seek a safe haven in those types of differentiated environments. The other has directly to do with the Fed's activity. The Fed's increase in the Fed funds rate has boosted the yield on US denominated investments, as we've talked about 6 or 7 times already. But foreign investments still are working with the very low yields, since they haven't seen their economies kickstart again. So the interest rates and central bank policies are keeping interest rates on their assets low. So another reason for investors to channel their currencies into the US, so they have to buy the dollar to invest in dollar denominated stocks or investments. And that's why we see the dollar appreciating right now. Yeah. We don't expect that cycle will continue forever. What goes up must come down, so they say. And when we do have interest rate parity, we should expect to see a reversal in that currency situation. So that's the end of our prepared slides. But as you may know, we like to close this discussion with reminders about, while it's good to know and understand all the information we've talked about, there really isn't much we can actually do about it except, stay the course, make sure we're invested appropriately for our goals and our risk tolerance and things like that. But this slide allows us to help us focus on those things, the things that we can do or at least control for. And we'll highlight that middle bullet point there. It seems like another appropriate time to maintain a disciplined approach. Don't let the emotions of the day or the emotional roller coaster that markets are putting us through get you off your track. And in fact, if nothing else, the takeaway from this presentation should be that just when you think it feels the worst, the time when you feel like it's time to bail, history has proven to us that that is the exact wrong thing to do. So if you can grit your teeth, understand that cycles will reverse, just try not to make too many emotionally charged, hasty decisions. And I'll kick it back to you, Bob, to close this out.
The only thing I'd like to close out with in regards to, the planning aspects and so forth is just about every client gets a financial plan, an investment plan, a cash flow plan. And if we had our druthers, that would be all that we focus on with the clients. If we could shelter them from the noise, from the chaos that transpires on a daily basis, and keep everyone in their seats, which for the most part, thankfully, our clients have been successful at doing, then I think our lives would be much better off. Allow the entrepreneurs and the business people and everyone go and do their job. Go out, the economists, make adjustments, tweaks, whatever needs to happen, and you go about your life doing the same thing for the things that are important to you and can control and so forth. So I'm not saying don't open up your statements. I think it's advantageous to still be aware and understand what's going on. But meet with your planner, meet with the person that you've been sitting with to discuss. And if you have big ticket purchases or that you're contemplating, or your monthly cash flow is more than you may need, then maybe if it would make you feel better to cut back or change an expense at this time, that's fine. We don't want people to have to adjust their lives too much. But it's worthy of a conversation if that's going to make you feel better. So that's all I would say to end out. And thank you, Mario, again for putting together such a great set of informative slides that will hopefully give our clients some understanding that this is not a one-time occurrence. Our economy, global economies have gone through this number of times in the past, and again have come out fine on the other side. So it's just a matter how you handle it during the uncertainty. So thank you.
Absolutely. You're welcome. Happy to do it anytime.
All right. Well, until we meet again for next quarter, I bid you well and look forward to seeing you in our investment committee meeting, Mario.
All right. Sounds good.
All right. Be well.
Thanks, Bob. Thanks, everybody.